Today we're taking a look at an alternate version of exercise 1110 from page 521 of the textbook. This is chapter 11, Reporting and Analyzing Equity. This particular problem is looking at recording and reporting treasury stock transactions. So let's take a look. It says on October the 10th, the stockholders' equity of Sherm Systems appears as follows. The company has common stock. It has a $10 par value. There are 81,000 shares that have been authorized, and all of those shares have been issued, and all of those shares are currently outstanding. So then the value of the common stock is just pretty simply $10 times 81,000, which gives us a common stock balance of $810,000. Next up, paid in capital in excess of par value common stock. That shows us $261,000. What does that really mean? Well, it means when the company sold this common stock, it sold it for above the $10 par value. That additional amount, that kicker that people paid for the stock, is simply credited here in that additional paid in capital excess account in the amount of $261,000. Also in its equity section, the company reports retained earnings of $936,000. So altogether, the total stockholders' equity is $2,007,000. Okay, so that's the amount of information we're given. Now let's read on. It says, prepare journal entries to record the following transactions for Sherm Systems. A. Purchased 5,900 shares of its own common stock at $34 per share on October the 11th. Why would the company possibly buy back shares that it had previously sold to the public? Well, a number of reasons, but when a company does that, they're bringing those shares back into the treasures of the company, and those are called treasury stock shares. Those are simply shares that were previously sold that the company says for one reason or another, now we no longer need those shares to be outstanding. We want to buy those shares back. Notice that will lower the number of shares of stock outstanding. So here the company is purchasing back 5,900 shares that it had previously sold its own common stock. And they're buying these shares back at $34 per share. Okay, so let's just do transaction A first. When a company is buying back its stock, if it is buying back 5,900 shares at $34 per share, what's the company going to give up? It's going to give up some of its cash. How much of its cash? Well, 5,900 times $34, or altogether, do the math, $200,600. So that's going to be a credit, right? Cash is going to be lowered by $200,600. What's going to be the offset to that? We're going to debit an account called Treasury stock. And as the Learn Smart module has instructed you, that Treasury stock is a contra equity account. It lowers down our overall equity balance. So when we look at our total stockholders' equity of $2,007,000, is that going to go up or go down as a result of buying back these shares of treasury stock? Well, it's going to go down. It's going to go down by the value of the treasury stock purchase. Well, let's go ahead now and move on to part A. Let's just record the journal entry for the A transaction. Remember, cash is going to go down, so we're going to credit cash and we're going to debit treasury stock. Treasury stock gets debited for $200,600 and cash gets credited for $200,600. Part B says we now are going to sell some of that stock that we previously bought back. Well, that's crazy. Why would a company do that? Well, companies tend to buy back stock for lots of reasons. One big reason is to kind of manipulate some of their earnings information. Their earnings per share number can change drastically if they buy back the number of shares outstanding. Let's look at a real simple example. Let's say you have a company with 100 shares outstanding, and your company in the year made $100. Well, what was the earnings per share? Well, 100 shares and $100, it must have been $1. The company made effectively $1 per share. Earning per share is a key metric that tends to drive stock price on Wall Street. How can a company make its price go up? Well, if they get a better earnings per share number. And what can they do if they can't really make the company more profitable to make that earnings per share number look better? They might buy back some of the stock outstanding, lower the number of shares of stock outstanding. So if you got that same company that next year has $100 in profit again, What can management do to make its earnings per share go up? Lower the number of shares of stock. Let's say we buy back 50 shares, that leaves 50 outstanding, right? Well, before we hit a dollar earning per share, $100 of profit, 100 shares of stock. Now we have $100 of profit and only 50 shares of stock. So our earnings per share magically goes up. It doubles to $2 per share. Now, companies typically buy back shares around the end of the year so they can manipulate some of those numbers. Yum Brands in Louisville, they do that every single December 31st. They lower the number of shares outstanding by buying excess shares back into the treasurers and lowers the number of outstanding shares of common stock. Guess what they do come January the 1st of the next year? They sell back some of those shares. And when they sell back some of those shares, they can sell them for what they paid, they can sell them for less, or they can sell them at a profit. Transaction B says this company is selling 1,225 shares on November the 1st of those shares that they previously bought. They're selling them at $40. What do they buy them for? $34. So are they making some money or losing some money on the deal? Well, they're making some money. They're selling them at a $6 premium. That $6 premium will be called additional paid-in capital Treasury. Now, one of the rules with Treasury stock is it has its own T account. And so when we buy back into the treasurer, we're going to debit that Treasury stock T account for the amount of shares that were indeed put into the Treasury. Notice it's a debit balance in that Treasury stock. Why? Well, because stockholder equity are right-hand side accounts that have normal right-hand side or credit balances. To lower that, we'll do that with a debit balance. So that's why Treasury stock is a contra equity account. In transaction B, when we sell some of those shares, we're going to take them out of the Treasury stock. And the rule is this, listen closely. We take those shares out of the Treasury at the price that they went into the Treasury for. So remember, they went in at $34 per share. We're going to take them out at $34 per share. So let's look at the transaction B. It says, we sold 1,225 shares for $40 per share. So how much cash did the company get? Well, 1,225 times 40, oh, they got $49,000 of cash. They don't have all that Treasury stock outstanding anymore, so that's got to go down by the amount that it went into the Treasury. It's coming out. So we're going to take $34 per share times the 1,225 shares. That's going to come out of the Treasury stock account. Now, that doesn't balance our equation though, does it? No, because remember, they received a kicker. $6 in excess of what they paid for is what folks are paying for it. So $6 times the 1,225 shares is going to go into that account called additional paid-in capital Treasury for $73.50. That's $6 kicker times the 1,225 shares. Now let's recap where things are then. This Treasury stock is no longer that same contra equity balance after we sold some shares. It now has a balance of $158,950. Okay? Now let's move on to transaction C. It says the company then sold all remaining Treasury shares on November the 25th. Ooh, but they sold them for $29 per share. So did they make some money or lose some money when they sold all the remaining shares? They lost $5 per share. We have to figure out how to account for that. How many shares are left now? Remember, they bought 5,900 back. They sold 1,225. So the difference is 4,675 is how many shares they're selling here. So first off, we're going to debit cash for the amount they're getting for those remaining shares. The $29 per share times the number of shares remaining is going to give us cash of $135,575. So cash gets debited just like before when we sold it. Cash gets debited 4,675 shares. Remember, that's the remaining ones after we sold them from transaction B. We sold them at $29, so we record cash of what we received from the folks that bought the shares. We received cash of $135,575. Okay, now let's actually jump down and look at the Treasury stock transaction. Remember, we have to take out those remaining shares, and they come out at what they went in for. So they went in at what price? 34 per share. Those 46.75 have to come out at 34 per share. It has a debit balance. How do we get those shares out? With a credit entry for 158.950. And notice that's going to bring our treasury stock balance now down to 0. Well, since we sold those shares, and if we had just these two transactions, the 135.575 and the 158.950, let's pretend these aren't here yet. With the first two transactions, the cash transaction and the treasury stock transaction alone, have things balanced. Let me highlight these two transactions so far. So we have the cash transaction and we have the treasury stock transaction so far. Okay, so we're definitely not in balance, are we? No, because 135.575 as a debit does not equal 158.950 as a credit. Well, since we sold those remaining treasury stock shares, what are we going to do to balance things? Well, we're going to take them out of the additional paid-in capital. The money that we received as the kicker up here, well, we're going to kind of use that up now. We can use up $73.50, so that's why I have the debit in the additional paid-in capital account for $73.50. Okay, that helps. It bridges the gap a little bit, but notice we're still not balanced. So what do we do to make up the difference? We take the difference out of retained earnings. So retained earnings becomes a plug to fully balance out when remaining shares are sold and we've used up any premium we've made before from selling owed shares. There's none left now, so we have to take it out of retained earnings. So now that our additional paid-in capital account is now at 0. And we've completed all three transactions, the purchase, the sell, and then selling remaining below what we bought them for. Let's move on. Part 2 says, prepare the revised equity section of its balance sheet after the October 11th Treasury stock purchase. Now recall, that was just the very first transaction, Transaction A, when they bought the initial Treasury stock purchase. This is not including when we sold 1,225 shares on November the 1st, or when we sold all of the remaining shares on November the 25th. The question is just asking us to prepare the revised equity section of the balance sheet after the October 11th Treasury stock purchase. And we kind of talked about that at the very beginning. When we bought the Treasury stock, what's happening to our overall stockholders' equity? It's just being reduced. In this case, it was being reduced by the amount of the Treasury stock purchase to begin with. Recall, we bought 5,900 shares at $34 per share, and that equaled $200,600. That's the amount that we'll simply subtract off of the equity section balance sheet that we saw on slide 1 when we started the problem. Let's continue and I'll show you how that looks. So we had the same thing from before, common stock, $10 par, 810,000 for all the shares that were issued. It was 81,000 issued and outstanding at that time. We had paid in capital in excess of par, 261,000. That didn't change either. Total contributed capital was 1,071,000. Retained earnings had not changed. That was 936,000. And our total was the same too, 2,007,000. So then what changed? The Treasury stock transaction simply has to be subtracted out of the total equity. Remember, the $200,600, how we got that? That was the 5,900 shares times the $34 per share, and that's the amount that we're subtracting out of stockholders' equity. It's a contra equity purchase, which gives us then stockholders' equity of $1,806,400. And that's the equity balance after the October 11th Treasury stock purchase.